Welcome to episode 21 of the Cashflow Connections podcast. The topic for today is taking Gelt Inc. from 0 to 1 billion in less than 10 years. In this discussion, we're going to talk about the mindset required to rapidly expand a business during one of the most vicious real estate collapses in history. We're going to talk about what markets our guest is bullish on versus the one he's really cautious about, and maybe ones he's completely avoiding altogether. We're also going to discuss building a team, a culture, and a business vision that invigorates your employees and your partners. This is something our guest has really mastered over the years. And towards the end of the conversation, we're going to go into a lot of detail about one particular multifamily apartment that Gelt took full cycle in Phoenix, which resulted in a really solid return for investors. And it really helped establish their track record with their investors as well as their track record in the market overall, which kind of created a snowball effect for them in the Phoenix market. So definitely a really interesting conversation. I think a lot of you are really going to enjoy it. Now, before we get to the episode, don't forget our new referral program for accredited investors is still available. So if you have friends or family members or coworkers that are accredited investors that may be interested in taking some money out of the stock market and investing it into commercial real estate, make sure to send an email to hunterthompson@cashflowconnections.com. As you probably know, the stock market is near all-time highs right now, so I'm sure they're going to be appreciative if you help them out in this area. And once I receive an email from you, I'm going to shoot you your personalized referral link so you can send them out to your contacts. And for each referral that uses your link to sign up and completes their introductory call, you get a $200 gift card to Amazon.com. Don't forget, though, this program is only valid until November 15th, 2017. So don't hesitate. Go over to a computer right now. Send me an email saying you want your referral link, and I will shoot that back to you so we can help your friends out. Thanks a lot. How's it going, everyone? Today we have Keith Wasserman, who founded Gelt Inc. in 2008 during the height of the recession and financial meltdown. Keith has been involved in the acquisition of several commercial, industrial, and residential properties, mainly in the Western U.S., now totaling over $1 billion in assets. Keith also co-founded Happy Homes Communities in 2017, which is Gelt's mobile home park arm, and he oversees the company's operations, marketing, investor relations, acquisitions, leasing, development, and disposition services. So he's got his hands in everything, making for a really interesting conversation today. Keith, thanks again for coming on the program.
Yeah, thanks for having me, Hunter. I'm excited to be on.
Absolutely. So before we jump into all the topics we're going to get in today, let's talk just briefly about your background. Tell us a little bit about what you were doing before getting into the real estate sector.
Yeah, definitely. So, I've always been very entrepreneurial. I'll take it back all the way, when I was young and growing up. My family is, born natural entrepreneurs. My father never worked for anyone in his life. He started his own law practice right out of college, and in the back room of another law firm, and just worked hard and smart, and just started with one client and two clients, and over time grew his practice into one of the largest law firms here in the San Fernando Valley in Los Angeles. And I think, he instilled that culture of entrepreneurship. And we just, growing up, we didn't really talk much about sports and entertainment. We talked about business and, the stock market, and just, my dad actually helped me start my first business, which was, it became one of the largest eBay stores. We sold over 200,000 items on eBay while I was in college from 2003 to 2007. And I'll rewind it even back further. When I was 10 years old, my parents would bring me to Costco to buy candy bars in bulk, and then we would go sell them, walk around the park and sell them one by one. So I learned the value of buying in wholesale and then marking it up and selling at retail, and that led me to that eBay business. And I really learned about making money on the buy and how to negotiate, and I learned a lot of good lessons and how to run an organization. We had 13 employees with the eBay operation, a 5,000 square foot warehouse. And I was doing that simultaneously while going to school at the University of Southern California here in LA. And, I've always been a very entrepreneurial guy. And when people ask what I do, I tell them I'm a professional opportunist. So, the next business I started, which we didn't even go out really setting to start a business. It just was the opportunity. This was December of 2008. My cousin Damien came to me with an opportunity for an investment. He said, look, you've made some good money with your other business. I have this opportunity to buy a 4-unit building in Bakersfield, California. And I said, where's Bakersfield? And he said, Keith, it's only an hour and a half north from here. And, the population in the MSA is around 800,000. It's a very viable market. And we could buy this fourplex for $150,000. And it previously sold for $450,000. So we went out to Bakersfield and learned the local market, and I like what I saw. The economy out there is based on oil and agriculture, and we always knew coming out of the recession that Bakersfield would really stay strong and take off, which it did. It added a lot of jobs. This was when oil was $130 a barrel or whatnot. And we bought that first building. We got an FHA loan. We maxed out our credit cards. We borrowed money from a friend, and that's what put us into business together. And we just kept growing. We bought one fourplex and then another one and brought in one investor, then two investors. And, over time, we look back and it's beautiful. We just kept, every day just growing the business and one investor and one property at a time. And like you said, now we've acquired, over $1 billion of assets and, over 7,300 apartment units and mobile home park sites. And that's in a quick 2 minutes, or 3 minutes, what we've done. But yeah.
Right. I mean, that's a pretty incredible story. I mean, part of that really sticks out to me is that, the mindset, particularly in California, people were just completely getting obliterated in the real estate market. So talk a little bit about the mindset and what it was like, the atmosphere when you were kind of pursuing real estate. How challenging was it to get people to invest in real estate when, there was blood in the streets pretty much like no other time in U.S. history? Yeah,
it was definitely scary. I'm not going to lie. There was so many of these fourplex REOs out there that we had our pickings. I mean, because fourplexes are still part of the 1 to 4 residential loan. So people were buying these during the height with very little money or no money down, just inflating the values tremendously. They're buying them with no cash flow. And, we knew in our gut we were doing something right, even though people were like, oh, well, Bakersfield, why? There's nothing going on in Bakersfield. It's just farms, but I knew I was on the ground there. I spent a lot of time. I knew my gut that, real estate, just like any business, is cyclical. The economy is always cyclical. There's recessions and then rebounds, recessions, rebounds. So it just felt like the right thing to do. And it definitely was hard convincing investors in the beginning of what we were doing, just because we didn't have a track record yet. So we did have to rely on our immediate network of family and family friends and clients of my father's. And literally, I mean, we had to, scrap by in the beginning. And we were listening to Napoleon Hill, Think and Grow Rich on the car, on audio on the way up to Bakersfield and back, just trying to figure out how we were going to raise our first, $50,000, $100,000. And, we were fortunate where we bought a few of these fourplexes and then sold 49% of that entity to one investor for like $200,000, and then started buying a few more of the fourplexes and just leveraged our network. And, it was a beautiful thing. But back then it was, we should have bought everything in sight, and it was hard to find the money. Now it's like the money's very plentiful because we have that great track record, but it's harder to find the deal. So it's interesting how times have changed, but definitely scary. But when, like Warren Buffett says, when people are fearful, it's the best time to be greedy and, just start acquiring assets. And, people did feel a lot poorer, I'm sure, during the time as the stock market was down a lot. But we were fortunate to have investors that had some cash still available to invest in real estate and for these distressed opportunities. And, I'm glad we were able to start at that time.
Certainly. What does your typical investment strategy look like at Gelt right now? So at this point, we've evolved a lot. So when we started in Bakersfield because that was the lowest, entry point where we could get started. And then, it was close to home and we were able to, really oversee the projects there. So we bought all 15 of these fourplexes, and then we moved into larger communities. We bought a 78 unit and 128 unit. And then a couple of years later, in 2010 and 11, we identified the next market as Phoenix, because Phoenix was decimated by the housing boom and subsequent bust. And it was really reeling. They had a whole immigration bill passed. They had around 100,000 illegals leave. And, some apartment communities were like half vacant. And we saw great opportunity to pick up assets there because blood was in the streets. And Phoenix is like the 5th or 6th largest city in the United States. It's not going anywhere. It's growing tremendously.
And we always felt in our heart that it was going to come back. I've been going to Phoenix my whole life because my grandparents live there. So I've seen it grow from a small town to a huge city now over the last 33 years. And, we moved there and bought 2,000 units in Phoenix. And then we started moving to new markets. As Phoenix, the prices got a little higher and higher. We said, you know what, let's go to a market that's a little more stable and not as cyclical as Phoenix. So we moved to Salt Lake City, which we have 1,000 units there. We moved to Denver a little later in the cycle than I wanted to. We were looking at stuff and getting outbid a lot, and I wish we bought more in Denver, but we have 1,500 units in Denver, and we've seen tremendous rent growth there. And that led us to Reno, another market that we identified. And quite frankly, we got lucky. We bought before Tesla. We didn't know Tesla was coming there. We just liked the fundamentals of Reno even before they had Tesla. And with the Tesla move and a lot of other technology companies, and they haven't had much new development, so the market there is really, really good for us. And then we moved to Portland, which is another market that we love, and then Albuquerque recently. So the last deal was Albuquerque, and people say, why Albuquerque, Keith? Just like when they said Bakersfield, why Bakersfield? So Albuquerque we like because also on the supply side, there's very little new construction going on there. There's been very little in the past few years, and pretty much very, very little coming online. So you have a supply imbalance where there's not much supply and there's this good amount of demand. There's still population growth there. Good, there's great neighborhoods in there. So we picked the best part of Albuquerque to buy in the Northeast, and buy a great school system and great asset that was running at around 100% occupancy, which is always an immediate sign that the rents are too low. So we came in and we've been aggressively pushing rents and adding amenities and just giving the property a facelift, and it's doing tremendously well. So we've always evolved and we look for opportunity and try to think differently. We're someone's zigging, we're going to try to zag kind of thing. So,
right.
And we selectively started selling a lot of the Phoenix deals. We actually are exiting Phoenix completely now. We have 2 deals in contract, so we'll have no properties in Phoenix. But we're still young, and I'm sure during the next recession we'll be back there.
So let me ask you something real quick, because you kind of touched on different market cycles going on in different markets at the same time. So tell me what it is about Phoenix in particular that makes it in such a different market cycle timing than something like Salt Lake. Is it just the supply demand curve, or is it something to do with the mentality of the buyers in the market? What's taking place there that is causing that stratification between those two markets?
I think it's all of the above. I mean, Phoenix, it's seeing a huge amount of supply come online. It's very easy to build there, quick to push projects through. It's a sprawling metropolis, and it's just easy to build, just like a market like Houston is, et cetera. And and then also like the buyers, you have a lot of California buyers that when prices get high here in SoCal, where we're from, they move to Phoenix. It's the next logical place. It's that or Vegas. It's an hour plane flight away, and so you have a lot of California buyers that are bidding properties up, and a lot of Canadian buyers also in that market. And we sold a few of our properties to Canadian buyers, and they just are looking for yield, and they tend Phoenix, it's just historically been very boom and bust, just like Vegas. So I think they just easy to build, which is good. In fact, it's business friendly, and a lot of employers like going there. The cost of living is lower, but it's it's very cyclical and just more of a timing market. Whereas Salt Lake City, it's I guess more difficult to build there, and it's just the population's been consistently growing, and we love Salt Lake. It's the youngest state in the nation. They have one of the best economies there, very educated workforce. So we're trying to diversify, and Phoenix is a market we liked at the time, but cap rates have been driven so low that we feel, if we're paying those low cap rates, might as well buy in our backyard here in SoCal, which, it used to be a bigger differential. It used to be a bigger differential, but now the cap rates are pretty close. So it's pretty crazy.
Give me an idea of what you're seeing, just so I get a perspective. In Phoenix, what's a typical cap rate in the type of properties that you're looking in?
Yeah, I mean, we're selling.
That you were looking in, I guess.
Yeah. So when we started buying in Phoenix, we were buying this in 2010, 11, 12 in the, I'd say 7% cap rate range, and even as close as 8%. And now deals there are trading the same deals in the, I'd say, 4.5 to 5.5 cap rate range. So, it's really tightened a lot, and it's just, as long as you see huge rent growth, it's okay. But rent growth is eventually going to have to start slowing down, and it's especially because having so many new product coming online, and it's I'd rather be buying in SoCal. We bought a deal in around here for a 5.4 cap in Southern California, and I'd rather buy at that cap rate level in an area like Southern California where it's even more difficult to build, and where international investors come, they perceive the safety here, and during market dips, it just doesn't drop as much as Phoenix and Vegas and stuff.
Got it. So you guys are in multiple different states. Property management is obviously key to the facilities of these type of returns to your investors. What are you doing in terms of your big picture strategy, in terms of either identifying property management, deciding whether or not to keep on the previous property management? Talk a little bit about that strategy.
Yeah, so we've decided, made a conscious effort not to be in the property management business. We really rely heavily on our third parties that are the best in those regions. So one of our go-to property management companies right now is AMC. They're based in Salt Lake, but they have a big presence in Portland and in Denver and in Salt Lake and here in SoCal. So I'd say over half our portfolio is with AMC. We have a great relationship with them. They're very aggressive. They've consistently met our budgets or surpassed and outperformed. So once you make a great relationship with one, we really stick with it. In Arizona, we had Allison Shelton for a long time, did a great job for us. And, who else? We have Horizon also in Salt Lake City. Sometimes we like having two different management companies in a certain market to create that healthy, friendly competition. And we could sort of see, how every management company works differently. They have different reporting. They, different nuances. There's no perfect management company. And, I think, look, if we were to do it ourselves, we might think we would do a better job. But truthfully, I don't think so, because we don't have a huge presence in any one market. Like, these management companies have tens of thousands of units in some markets, and they've been there. They have office there. They have staffing there, and they actually, I think, would do a better job. And they have economies of scale, and they know all the local contractors, and so we really rely heavily on them. But we really try to form a partnership where. In some cases, we've given a piece of the promote to the management companies to really align them and make sure they put their best staff and best eyes and ears on our properties, and and put their best foot forward. And we interview usually 2 or 3 in each market that we're in, and but we have had to make some changes in the past. And it's the old adage, slow to hire, quick to fire kind of thing. And usually when we buy a property, we usually like coming in with new management, unless one of our management companies are already on it. Sort of like the whole new, especially if it's a big renovation and we're trying to change the way the properties run, and it's nice to have a new sheriff in town kind of thing. So we usually clean house on the staffing and bring in new fresh eyes and ears to the property. But it's on a case by case basis, I'd say.
What financing are you typically acquiring for these purchases?
Yeah, so I'd say 95% of our purchases are financed with these Fannie Mae and Freddie Mac loans. They are the most aggressive in terms of rate for long-term fixed rates. They're the most aggressive, which all our borrowing has been to this date. And because we're very conservative, and I don't want to take any interest rate risk, and we're holding these properties mostly for the long term, and these loans could be assumed as well. So if interest rates ever start rising, there's going to be a lot of intrinsic value in these loans. It has hurt us a little bit when we sold some buildings, because the only negative thing is they have these big prepayment penalties. So if a borrower wants to put fresh debt on the properties, which they have in the past, these rates kept even going lower, to our disbelief. But no one knows exactly when rates will start rising, if they do, or if they keep going down theoretically. but we're just very conservative, and I'd rather be able to sleep at night knowing what our mortgage payments can be for the next 10 to 12 years rather than having an adjustable rate or a loan that's a shorter term like some of our competitors do, these 5-year or 7-year. I'd rather stretch it out and just have more certainty, I'd say. So Fannie, Freddie, we get those through these different DUS lenders. We use CBRE a lot. We've used Meridian Capital. I mean, whoever is very competitive in those markets and who have relationships with, we've used in the past.
Yeah, I think you brought up a lot of good points there. And I keep harping on this for the listeners that have listened to a lot of these episodes. But the financing is probably the single most important determinant of a lot of these assets. So if you're buying in markets that have what Ethan Pinner calls viable real estate, right? They're markets where they're experiencing job growth, they're experiencing income growth from jobs, and there's demand for the product. You're going to be able to weather economic storms as long as you have in place appropriate and conservative financing with a term that's long enough to allow you to implement some kind of value add strategy. So when you're looking at Fannie Freddie with 10 to 12-year debt, if you're buying in these markets like Denver and Salt Lake City, even if there's a correction in prices, you can relatively rely on the fact that prices will return. But what's more important is the fact that you're going to be in a safe position in terms of paying your debt service coverage ratio. And that's really when a lot of horror stories happen in real estate. They're going to happen as a result of people not having conservative financing in place. So you're really limiting your downside, which is kind of a great segue into the next question, which is, other than kind of taking those more conservative loans, what strategies do you implement to protect investor capital?
Yeah, so that's number one. Number two is we always raise a lot of extra money. We call it rainy day money, where we just stock it away in our bank account. So we never have to go back to investors and do capital calls because, first of all, investors, they don't want to be put more money in. They come in with the investment in mind. This is how much they put in. They don't think they're ever going to and never want to put more money in. So, and usually when you do the capital call, it'll be in an environment that the economy is bad and they're probably, maybe their business is doing worse or their stocks investments have gone down. It's just not a good time to put money in. It's going to be tough. So I'd rather, raise more money up front, and it'll lower the cash flow a little bit, the percentage rate of return and the, total IRR and stuff. But I just sleep better at night knowing we have a great cushion in the bank for each property. And we let it grow over time. Also, we usually keep stashing away money and, just for a rainy day, like you said, when occupancy drops and rents drop, it's going to eventually happen. I mean, real estate's cyclical. We'll be able to, we could always halt the distributions and just feed the property for a long period of time until the recession's over and it bounces back. But thirdly, we don't over leverage. We always take very conservative leverage. A lot of people I know are getting these, maxing out the leverage and getting mezzanine debt on top of it. And I mean, we've seen some great properties that were lost to the bank just because, the loan came due and they were over leveraged, or, they during the recession, they weren't able to make their debt service because, the occupancy dropped and rents dropped and they had a high payment still. So pretty conservative in our leverage, keep that extra cash. And, it's really helped. We've never had any projects go bad. We've never lost a single dollar of investor money, and we want to keep it that way.
Makes sense. We mentioned Phoenix earlier, so I know you guys were really heavily involved in the market earlier on and then have recently been kind of cycling out. So I wanted to kind of talk about the details just to go into, give investors an idea of what these purchases look like and what are some of the questions investors should be asking when they're reviewing deals. So if you don't mind, let's talk about one of your deals in Phoenix that was recently taken full cycle.
Yeah, definitely. So one of the most exciting deals we did, it's a great story. So this was back in 2010 or 11. Blood was in the streets in Phoenix. Very few transactions were being done. We, my cousin Damien and I, my business partner, walked into the, Phoenix brokers' offices, and, they were very forlorn. It was a tough time. We came in and, we were young, we were 24, 25, and Damien was like 28, maybe 29. So we were both in our 20s, and we had maybe 350 units, I think, in Bakersfield and nothing in Phoenix. And we said, look, we're looking for apartments to buy here. We like the market. And they recommended we come in and buy a small building to start and build credibility, et cetera. And it's funny. One of our first tours, we loved this building. It was 415 units, not small at all. It was called Fern Tree and Colonnade Gardens. It was owned by a big REIT called AIMCO. And, I met the broker there, and he takes a look at me, and he sort of writes me off, younger guy. And, he usually people in this business are older and, more experienced. And I had a few years under us, and we had a good amount of units, but nothing in that market. And, we come there and tour, and it's a massive sprawling property. It's 10 acres of land, but it's very, very prime land. It's on Camelback and right by the Biltmore Hotel. If people are listening that know Phoenix, it was Camelback and like 20th, give or take, the cross street. So by the Biltmore Hotel, right in the Camelback corridor, prime location. And the building was very old. It was built in like the 60s and 70s in phases. It had 5 pools, 5 chillers, 5 boilers. It was just an old property, and the seller, we were looking at it, and it was listed, and then no one bid on it. So because it was mainly studios, like small studios and 1-bedrooms, and a lot of people were saying, "Oh no, that's silly. You got to buy stuff that has more, 2 bedrooms for families and whatnot." But we knew in our gut this is a market, in an area that a lot of young single kind of people, millennial people would live. It's a lot of office space around there, retail, a lot of jobs there, and I felt that the studios and 1-bedrooms would actually be fine, and even better maybe because it would be a lower price point. So we bid on the building. We somehow were able to tie it up in contract. I think we eventually closed on it for $16 million, and we raised $5.5 million from around probably 50 investors, give or take. And we actually even though we closed it, it took 6 months afterwards to continue to raise the money. So we closed it with lines of credit. We borrowed money from friends and stuff just to get it closed. And we kept raising the money 6 months later. And, it was one of the best deals we ever bought. We bought it. We did, we probably undercapitalized a good amount. We only raised an extra, maybe, I think $750,000 to $1 million for the renovations. And we quickly went through that because the property was old. It needed a massive repipe. We added new washers and dryers in the laundry rooms, these high-tech ones where you could like text the machine, it'll text you back once it's ready. We added these new cool gazebo areas, repainted, and started doing some renovations of the interiors, but quickly ran out of money. And a few years ago, we actually listed the property and exited. We listed it with the same broker that was sort of like suspicious of us, and he's now became one of my closest friends, and it's a good story. He's one of our great investors, and now we've bought, I think, 4 deals from him there. So, we really changed his mind about us, and we sold that building for $25 million 2 years ago. It was a huge home run for our investors. We put some good money in our pockets as well. And but back to the adage of, kind of never selling good properties in good locations. The building that, the buyer we sold to put, I think, around $5 to $8 million into it and did the proper renovation to it. And then they sold it for $43 million. So they made a good amount of money. Yeah, pretty crazy. It was a little heartbreaking. But then I did the math and I said, you know what? If any of the investors, that sold put money into our next deal, those deals went up tremendously, and we've sold those subsequently. So they would have made the same amount of money. It's always hurtful to see, property sell. But I think, whoever bought that building now it's a very, very old property. And even though it was renovated, I just don't, we'll see. They did a big loan, very highly leveraged, and we're going to track it. And I know a lot of people that have over the years sold buildings and then bought them back at much lower prices in the future. So I'm not saying that's going to happen, but we're always tracking buildings that we've sold, and just because we know them intimately, and there's always a chance to perhaps have a second date with with this kind of property. So
makes sense. So you bought it for 16, sold it for 29, or sorry,
25.
Do you remember the cost per door in that range?
Yeah, so it was 415 units. So we bought it for around a little less than $40,000 per unit. Which was dirt cheap. But looking back, what we should have done is probably scraped it and, built, either sold it to, got it entitled and sold it to a developer to build, a new apartment community, or maybe partnered with a developer and built it ourselves. It was just prime, irreplaceable land, 10 acres of land in, the heart of the Camelback corridor. And our basis was so low. It was, around 40,000 per unit. We, put in around $1 million into the property, which, the next person put 5 to 8 million and did the, huge renovation, which it really did need. But we couldn't, at the time, we didn't have the capacity to raise that kind of money. So, 5.5 million, even that took 6 months to raise. That was our biggest raise by far. The biggest raise before that was like 2.5. So it was over double. So, and we were just building our track record. Now a $5.5 million raise is, we do that, within the first 8 hours of sending out our offering memorandum to our investor base. So times have definitely changed, but it was a great success. When we bought it, a lot of people didn't look at it also because it had interest. It was really screwy, the loans. It had 3 different loans. It was 2 different properties next door to each other. So one property, we had to assume 2 loans, another loan, and we had to put a supplemental on that other one. So there was like 4 total loans, and it was above market interest rate, and the loans came due pretty soon. So that's why I think we got a great value though on the property. So, the rates were higher, but the value subsequently was lower, because if we were able to place new debt on it, the cash flow would be a lot higher, and then someone would pay a lot more for it. So you just got to factor that into the pricing. Like you said, the financing is always very, very important.
Okay, cool. So I just wanted to circle back on that just to make sure that I understand. So you bought the property and assumed a loan that had a relatively short balloon, and then you created a new financing. Is that correct? Or did you get new financing when you purchased the property?
Yeah, so there was 2 properties next door to each other. One had a existing first and a second on it, and then the one next door just had a first at very, very low leverage. So we were able to, when buying the property, we assumed on that first property both of those loans, and then the property next door, we were able to procure a second that was even bigger than the broker put in his package that he thought we could get. So that helped a lot. But all those loans combined, blended together, were at a higher interest rate than if we were to get, one new loan for the whole property. So we did have an above market, total blended rate that we were paying. I think it was like maybe 6.5%, and the interest rates were maybe 5.5% at the time we could have got, or something like this. So, but that's just fact. You just got to factor it into your price. So, if we were able to put new debt on it, maybe we would have paid more, maybe 17, 18 million. Just because the cash flow would have been a lot higher. But, assuming financing usually takes a lot longer. Which was good in our case, because it took us time to raise the money. We've bought subsequently a lot of deals where we've had to assume financing, and it's better in that you usually get a lower price on the properties. But you just got to be careful if how much time is left on the duration of the loans, and you just got to factor that in when you're pricing the property.
Yeah, it's a really good point. Were you doing a lot of interior renovation, or was mostly just the piping and stuff like that you were rehabbing?
Yeah, not too many of the interiors. We did a few just to try to prove it out and sell the sizzle to the next buyer. Usually when we come in and buy these properties, we like doing a portion of the units renovated, and then we always keep a portion, we call it classic, non-renovated, so we could have a tiered price point. So if we have someone that can't afford maybe the renovated, and we always have that classic. Plus it's nice to help sell the sizzle to the next buyer if we wanted to sell the property. So we always leave a portion of the building. We would have wanted to do more renovations, but we just didn't have the capital to do them. So.
Got it. Do you remember what the overall loan to value was when you had all those loans kind of going at the same time? Or I guess 2 loans going at the same time? Yeah.
So, we bought it for 16. So, 4 million would have been 75%. We put it probably 4.5. It was probably around 70%, give or take, I think.
Okay. And then you also put about $750K, I believe you said, in terms of capital expenditures. So that also increases the value of the property as well. So when you're looking at the overall loan to value, you want to take into consideration the fact that once that 750,000 is expended, it should at least increase the value of the property by at least $750,000. That's just like being very, very conservative. Do you remember what the debt service coverage ratio was in the beginning before you kind of implemented those value add strategies?
Yeah, so the lenders have always implemented that 1.25 is like the lowest, at least Fannie and Freddie are going. So it was, at least that, or if not higher. So, but by the time we were done with our magic and rents were rising, and a lot of it was cap rate compression, quite honestly. When we bought it at 8 cap or 7.5 to 8 cap, we sold it for in the 4.5 to 5 cap range. We weren't geniuses. We just bought it right. And, we always have a saying, run it like a Honda. We don't over improve the property. We take good care of it. We had to do that big repipe. We replaced some of the water towers there, and, it was an old property, and we just took good care of it. And we do that for all our properties, add amenities, don't overspend. A lot of our peers get in trouble by overspending, and just, you don't get that incremental rent bump unless it's like a great market. We usually spend maybe $5,000 to $10,000 on average on our total, property renovations per unit. And, but we spent, 40 to 50 on deals in LA here where the rents were, $1,500 below market. We had one deal that was just being slummed completely, and the rents were like $1,000, and now they're, $2,500. But that justifies spending that kind of money. Otherwise, if you could only bump the rents $100, $150, $200 like our normal deals, there's only a limit to how much you should spend to get that ROI.
What was the age of the property?
It was built in the 60s and 70s. It was pretty old. But that's what we specialize in. We take good care of these older properties, and the older properties usually have less bidders, because a lot of these REITs, they have in their mandate, they have to buy buildings, 90s or newer, or nowadays 2000s and newer. Wall Street sort of dings them on their stock if their apartments are too old. And, we always raise a lot of extra money up front to be able to handle all the capital improvements over time on these properties. And, like we said, we take good care of it, but don't over improve. And that's sort of been our specialty. And, a lot of the sellers know that's our specialty, and they feel comfortable with us buying those properties. Whereas a lot of buyers that aren't comfortable buying, they're maybe stretching to buy older buildings for the yield. They don't know how to really run and do these huge, capital improvements. So I think that's a good niche. We buy larger properties and older properties, and it's served us pretty good so far. We are going to start looking a little at the newer properties, just because a lot of these value add deals have compressed so much in cap rate. And if we could get a newer building at a close to kind of return as the older one, we're always constantly looking and learning and evolving. But yeah.
Makes sense. So you mentioned you sold it at a cap rate, sub 5 cap rate. Do you remember how the deal was underwritten in terms of what your expected cap rate on an exit was?
Yeah, I mean, we expected a lot higher cap rate. So usually when we buy a building, no one knows in the future what cap rates will be. So we conservatively just add usually about 10 basis points per year. So we always, if it's a 10-year hold, we always underwrite usually a 100 basis point higher cap rate. So if we buy at a 5 cap, we'll say, worst case, we'll have to sell it at a 6 cap. So when we sold it for $25 million, we weren't projecting that number until like 10 years from now. And it was probably even lower than that. So, we thought it's a great way to, we hit a 10-year return or more within, 3 or 4 years. So we were like, oh, this is great. Let's sell it. And then, the investors will redeploy the capital for sure into our next deal, which they did. And then some. They tell their friends and family. So we sold a lot to create a track record also. But long term, we're really looking to build a portfolio and, just sell selectively, but really try to just build a nice, substantial portfolio.
Makes sense. And one of the things you touched on there, so 10 basis points a year, I mean, that's definitely a good, solid, conservative strategy. So for those people at home, you want to make sure that when you look at deals, you want to make sure at least that they're underwritten to be purchased and sold at the same cap rate. And if you want to be more conservative, you'd underwrite to something like, let's say 10 basis points a year, or, 75 basis points during the course of the hold period, whether it's 7 to 10 years, something in that range. That'll kind of give you an idea of what's conservative and aggressive and kind of industry standard. And how long did you hold it totally? So you bought it in 2010 and it was just recently exited.
Yeah, we bought it, I think 10 or 11 and sold it a couple years ago. So it was about a 4-year hold, I think.
Awesome. So I really appreciate you going into the details there. I know the deal's kind of come and gone, but it'll give the investors a good idea of kind of what I look for in certain deals and a kind of a brief summary of the specifics. I know a lot of the more sophisticated investors are going to be interested in a lot of your thoughts on that. So, I want to talk about Gelt real quick before we close out. I went to a meeting that you guys hosted recently, and it's very clear that you have built a great team of a lot of like-minded people that really seem to be drawn to you and the team that you've built. What are some of your thoughts on building a team and a company culture, and maybe some suggestions for those people that are in the process of building the real estate team?
Yeah, definitely. So, look, in the beginning, I used to do everything myself, and I learned you could only be a certain size if you do that. Without delegating, we were going to always remain small. So, as soon as we were able to afford, our first, hire, we hired one, and then two, and then three, and we never have gone out to hire, which is pretty cool. Always every week I have people coming to us to talk, and, they're looking for work, and if I really like someone, then I'll introduce them to the rest of the team, and it's sort of a collaborative hiring process here. If I want everyone on the team to sort of validate this person, and we spend a lot of time with the people before we hire them. Now we have 17 staff in total, and company culture is extremely important as we continue to grow. I think just being authentic and transparent, and take good care of your people. They're really like family. I call it the Gelt family. Just like when we have new investors, I call them welcome to the Gelt family, and I always thank them for their trust and investment of their hard-earned dollars. So I always thank our employees. I keep them. I really call them as partners, all of our employees, because they're so vested and they work so hard, and over time we always incentivize people by giving them pieces of the deal and stuff. And I know some other real estate companies where they just set them with salary and don't let them participate in any of the upside, and that's totally like against what we believe in. And we're always trying to align their interests with ours, and give them good bonuses and good parts of the deals over time if they've worked here and really proved their value. And we always tell people you're paid what kind of value you bring. So if you want to make more money, make yourself very invaluable. Make yourself we're irreplaceable in the organization. So we've had people we've hired. I'm not a big believer in like grades and school, and as long as you're hungry and willing to work hard and learn, that's the most important. So we've hired people that were previously, one guy, our COO, worked in brokerage for a year, sort of got burned out, didn't love it. Worked at Barnes & Noble for a little while. We picked him out from Barnes & Noble. He was so aggressive and kept coming back and was so hungry, and, started bringing us deals and started coming to work before we even hired him. And now, he's our COO, runs the day-to-day operation. He started as an asset manager and then helped with acquisitions, and now, literally runs the whole day-to-day. And, our director of asset management, he a great guy, great heart, knows how to deal with the property management companies, stays really on top of them, but rules them, without being a dictator kind of guy, really empowers them. And we picked up from Lululemon. He was working previously, but he kept coming, he went out to drinks with us, and we really liked his personality and, his morals, and, how he views life and work. And, he's been a great hire and great addition to the team. So yeah, and we started him very low salary. Everyone was starting, back in 4, 5, 6 years ago, very low, maybe 1,000, 2,000, 2,500 tops per month. And over time, that's just grown exponentially as they continue to grow with us. I believe if the partners are making more money, the staff has to make more money too. So, we're only as good as our people here. So, really believe in treating the people well, and, really making them part of our family. We had our first corporate retreat, which was a lot of fun. We went to Ojai. We rented out a whole huge, multi-structure property where everyone came with their families, and we had probably around 30 people, and we had, games and yoga and massages, and just, we spent a lot of money doing it, but I think it was money well spent, because it really got everyone closer and bonded, because we worked together. And it's nice to be out of the office doing some stuff together. We're going on a charity event, a big hike, in the upcoming few weeks. So just, places out of the office where we could bond together and get closer, and it'll help with our communications here at work, and, communications is vital, making sure everyone's talking with each other and, getting things done here. So.
Awesome. I actually didn't even know those two stories in terms of the origination of some of those employees and partners. Like you said, that's pretty incredible. And I know that you guys have had just an incredible run up, basically going from 0 assets to 1 billion assets in about 9 years or so, and raising a total of probably about $250 million in equity over those years. And I imagine that not only building a team to kind of facilitate that infrastructure required to take on that task, there probably has been some really exciting moments in terms of raising that equity, in terms of the quality of the meetings, the quality of the investors you're bringing on. What are some of the takeaways you got from some of those meetings when raising capital with new investors, so that some of the other younger entrepreneurs out there that are see themselves raising that kind of money in their career could really take away from?
Yeah, I mean, I'd say, being authentic to yourself, being honest. If I don't know something, I'm not going to make it up and tell them lies. I tell them I'll get back to them and, consult with someone. I've been honored to have great mentors. That was one of the first things we did, starting the business, is seek out people that are smarter than us and that have done it before. We're not reinventing the wheel here with real estate. People have been renting households for hundreds of years. So just learning as much as we can and being authentic and really, under promising and overperforming kind of thing. That's always been our DNA. We underwrite very conservatively so we could, at a worst case scenario, and then always do better than that. So yeah, every day pretty much I'm meeting with current investors and potential investors, and I'm getting calls from potential investors every day, and it's all spread word of mouth. We have 450 high and ultra high net worth investors. They're all accredited. As long as they're accredited, we could deal with them. And our minimum investment amount is $100,000, and that's what's stated in the OM. But if we really like someone and we feel like they could grow with us, we'll let them in for $50,000, even $25,000. I let some of the younger people that don't have the same resources but are up in their careers and want to start saving and building that nest egg. So I'd say it's all relationships and personal relationships. People are investing with us. I could put any numbers on a piece of paper and show the deal is going to be, crazy returns and stuff, but I want to be able to hit these returns and build a relationship and be honest and transparent with our investors. So if, things aren't going well, we've had properties where we've had, fires and floods and maybe some quarters where we've been a little lower. We always, are very transparent and open with the investors. And yeah, I mean, we've raised $260 million now from the 450 people, and we have them from all walks of life, from all around the world. Most of them are from LA, just because that's where our investor, our base is, where we started. But we're now making friends and relationships all around, from China to Israel to Australia. And it's really exciting to see. And all over the world, investors are looking for American real estate, and specifically multifamily, because of the stability and belief that it's a much safer place to invest their hard-earned money. With the American system of ownership of real estate than in their home countries, and it's been exciting to see.
Awesome. Well, Keith, before I let you go, I just want to ask, or I guess give you the opportunity to mention the Gelt Foundation, which I'm a huge proponent of. So give us just a brief rundown of when you guys started the Gelt Foundation and what your objective is on that project.
Yeah, definitely. So being a professional opportunist and always giving back, I've been raised that you always want to give back to the communities that you're involved in. And so I started giving small amounts of money in high school, $15, $20, $100. And then those numbers became bigger and bigger. And now every year, we're giving in the multiple hundreds of thousands of dollars to different charitable organizations. And I think we support maybe 20 different charities. But I said to Damien, my cousin, I said, why don't we start our own charity and, name it the Gelt Foundation and do something that has to do with our industry. And we thought and brainstormed, and we said, why don't we start a 501c3 and, where we can take outside capital, because we have limited resources and we want this to become huge. So what we started the Gelt Foundation for is to provide rental assistance for renters that are at risk of being evicted. So a family or an individual that has a job loss or a big medical bill or a big car, fix that has to be done, 60% of renters live paycheck to paycheck. They only have 60% of Americans only have $1,000 or less in savings. So if an unforeseen, economic hardship comes, they're sort of shit out of luck. It's really sad to see. And, they either leave their place of their home or even worse, get evicted. And we want to try to prevent these evictions. So we're going to be giving rental assistance for people that have been responsible, tenants for a while and just have some kind of issue come up, and in the form of grants, or we're going to start maybe potentially doing interest-free loans. So we literally just got our IRS approval a few weeks ago, and we're really excited for this. We're in the process of forming a responsible landlord association. So, we want to get other landlords on board, not just giving of their money, but, stamping this plaque on their properties. It'll probably be in the form of a plaque and a whole website that'll have our guidelines. And as long as you offer this foundation where people could, go if they're at economic risk of, being evicted, the landlords will be part of this association. And just wanted to give back in the community that's helped us so much. Being in the apartment community. And I think it'll hopefully help the whole relationship between landlords and tenants. Landlords have been historically seen as sort of, money and greedy and whatever. And we want to show that we have a heart for renters. And so we formed that 501c3 recently.
Awesome. Well, it's definitely something that a lot of people can get behind. Keith, I can't thank you enough for coming on. A lot of good stuff here. So thanks again.
Yeah, thanks for having me, Hunter, and I'm really excited, and hopefully the fans out there enjoyed it, and they could feel free to email me. I'm always available on email. My email is Keith, Keith, @geltinc.com, GELTINC.com. I'm always available, and they can follow me on Twitter and LinkedIn. I'm active on social media, and would love to connect with anyone that wants to reach out.
Awesome. Thanks again, Keith.
All right, thanks, Hunter. Take care.
For listeners out there, thanks again for checking out the episode. I hope you enjoyed it as much as I did. As Keith mentioned, his contact information will be listed in the show notes page. And again, remember the referral program. Now that you're done with the episode, you're probably finished with your daily drive. If you're still driving, make a note to send Hunter Thompson an email at hunterthompson@cashflowconnections.com so I can send you your personalized referral link. Anybody that uses that link to sign up and completes their introductory call, you will get a $200 Amazon gift card sent directly to you. So don't hesitate. Go ahead and shoot me that email as soon as possible, and we'll get you those referral links. Thanks again.